The real question here, is it always sunny at Sunny Corp? I would guess so, right? Let's look at the facts. So they're a US GAAP reporting company, and they were incorporated at the beginning of year one, right? So that means that this is the first year of business. So at the beginning of the year, it's a blank slate. Everything starts at zero. Now, we're given the balance sheet at the end of year one, and then the question gives us some more information, but ultimately, we need to calculate the net change in cash flows from operating activities under the indirect method. So this question gives us a bunch of different information. Some of it impacts other aspects of the cash flow statement. So what I'm going to do is prepare a full cash flow statement based on everything in this question. And then at the very end, we'll go back and go, okay, what's the operating section and how much cash was provided? That will give us the correct answer. So as we learned in the lecture, using the oops, I forget phrase, there's three key sections: the operating section, the investing section, and the financing section, right? So we'll start with the operating section under the indirect method. And as you can see in our visual here, our mental map for the indirect method, we always start with net income. So the question gives us net income of $78,000. So that's our starting point. And then we need to add back non-cash items and then any gains or losses. Now the question doesn't give us any of that information, right? Now typically they should, but they don't here, so we'll ignore it. Now what they do give us is the balance sheet, and we're going to have to calculate the change in current assets and change in current liabilities and see what the impact is on the cash flow statement for the operating section. So looking at the balance sheet, the only assets they give us are cash and accounts receivable. Now cash, that's excluded from the cash flow statement because that's what the cash flow statement's all about. However, accounts receivable, we will need to factor that in. So if at the beginning of the year we had zero and now we're at 82,000 at the end of the year, well, accounts receivable increased. And as our visual tells us, well, when accounts receivable increases throughout a period, that results in a net decrease to cash. So in our cash flow statement, that's going to be negative $82,000. Because in our net income figure, right, we recognized revenue of 82,000 when we recorded that accounts receivable, but we have not yet collected the cash from our customers there. That's why there's an $82,000 decrease from this change. Now, on the current liability side, the only item we have here is accounts payable. The visual off to the right shows us that when accounts payable increases, which it went from 0 to 24,000, well, that results in a net increase in cash. And why is that? Well, that's because net income includes operating expenses that we haven't actually paid in cash yet. So we're deferring payment. That's going to increase our cash flow. So on our cash flow statement, that's going to be a positive $24,000. So now that we've captured everything that gets included in the operating section, we can figure out what's the net cash provided from operating activities. Well, that sums to $20,000. Now, we're not going to jump ahead, but that's probably our correct answer. But let's go through the investing and financing section. So for the investing section, well, there isn't anything here that gets mapped to the investing section. There's our visual, right? Read through the options. There's really nothing in this question that's going to the investing section. So we'll leave it as no activity. So our final section is the financing section. And when we think about that, right, it's either going to be debt or equity related financing activity. So there's two items that will be included in the financing section. That's going to be the issuance of common stock, right? We're giving stock to shareholders. In return, they're giving us cash. So that's going to be a cash inflow of $200,000. And then the other item is dividends distributed to those shareholders. Now, this probably happened at the end of the year based on actual net income that was generated, right? And this is going to be a financing activity, right? You can see it's number 4 under equity financing. And when we pay dividends to shareholders, that's an outflow. And that's going to be a $28,000 outflow. So those are the only two items. That means the net cash provided from financing activities was $172,000. So now we've gone through everything that goes into the cash flow statement. What's the net increase in cash for the year? Well, it's the $20,000 from the operating section and then the $172,000 from the financing section. That totals to $192,000. Let's do a quick reconciliation on cash. Well, at the beginning of the year, it was 0. Now cash at the end of the year is $192,000. And guess what? That matches the cash balance on our balance sheet. So we know that we did the statement of cash flows correctly. Now, going back to what the question's asking, all it was asking about was the net change in cash flows from the operating activities. That's going to be the $20,000 that we calculated in our statement. So $20,000 is the correct answer.